We are just 40 minutes into the live trading session on Monday, November 10th, and Navitas Semiconductor, ticker NVTS, is trading at $9.04 a share. It is up an explosive 15.3% on the day, on absolutely massive volume of over 8.6 million shares. And this is where the story gets incredibly interesting. The expectation, based on all conventional market wisdom, is that this stock should be collapsing. Instead, it is ripping higher in one of the most aggressive short squeezes we have seen in the semiconductor space this month. Here is the reality that is colliding with that expectation. Just last Friday, on November 7th, after the market was reeling from a disastrous earnings report earlier in the week, Navitas announced a $100 million private placement. This wasn't a premium offering. They sold 14.8 million shares at a price of $6.75. The market predictably hated this. The stock plummeted, closing Friday's session down over 11% at $7.84. That $100 million placement, which is expected to officially close today, was seen as a dilutive, desperate move from a company whose revenue is in freefall. The expectation was that the stock would be pinned to that $6.75 level, or perhaps fall even further as investors digested the dilution and the awful guidance. But the reality, what we are seeing live on the screen, is the exact opposite. The stock gapped open higher and has not looked back. This is not normal behavior. This is a clearing event. The market has decided that the $100 million in cash, which the company desperately needs to fund its new strategy, is now secured. The Band-Aid has been ripped off. The uncertainty of the capital raise is over, and the high-risk, high-reward bet on the company's future is back on. To understand this move, you have to understand the sheer chaos of the last 7 days for Navitas. It all started on November 3rd when the company reported its third quarter 2025 earnings. It was a complete miss. They reported a loss of 9 cents per share when the street was expecting a loss of 5 cents. Revenue was even worse, coming in at just $10.1 million, well below the $10.79 million expected. This wasn't a small miss. This was a 53% decline in revenue year over year. The new management, led by CEO Chris Allexandre, who took over in August, then dropped the other shoe: fourth quarter guidance. They are guiding for Q4 revenue of just $7.0 million. That is not a typo. $7.0 million. This is a catastrophic collapse of their current business. The expectation, listening to that call, was that this stock was fundamentally broken. But here is the deeper reality, the narrative that is fueling today's 15% surge. This revenue collapse isn't an accident. It's a deliberate, strategic execution. The new CEO has initiated what they're calling Navitas 2.0. This is a painful, full-scale pivot. Navitas built its 1.0 business on gallium nitride chips for the low-margin, high-volume consumer mobile charger market, primarily in China. That business is now being intentionally deprioritized, or in plain terms, abandoned. The Q3 miss and the Q4 guidance collapse are the direct, painful, and very real consequences of management walking away from that entire segment. They are choosing to burn the boats of the old business to focus 100% on the new one: high-power markets. Navitas 2.0 is an all-in bet on AI data centers, performance computing, energy infrastructure, and industrial electrification. The $100 million they just raised at $6.75 a share is the war chest to fund this transition while the legacy revenue streams dry up. This entire bull case hinges on one single powerful catalyst that emerged last month: On October 13th and 14th, Navitas announced that it was a key power semiconductor partner for Nvidia. Specifically, Navitas is providing its next-generation gallium nitride and silicon carbide technologies for Nvidia's new 800-volt DC architecture for its AI factory computing platforms. That news connecting their name directly to the undisputed king of AI, Nvidia stock, sent NVTS shares soaring over 25% in a single day. This is the entire expectation. Investors are ignoring the $10.1 million in revenue today because they are dreaming of the multi-billion-dollar addressable market of powering the AI infrastructure boom tomorrow. They see Navitas not as a failed charger company, but as a picks and shovels play on AI, much like investors piled into Tesla stock, not for the cars it was selling then, but for the future of electrification. The 52-week range on this stock from $1.52 to $17.79 tells you everything you need to know about this narrative. The disconnect is staggering. On one hand, you have the bull case, fueled by the Nvidia partnership, which is so powerful it's causing a 15% short squeeze today. On the other hand, you have the bear case, which is grounded in the company's financials. Analysts are almost universally on the sidelines. The consensus rating is a hold, and the average price target sits around $6.50 to $6.73. At $9.04, the stock is trading wildly above Wall Street's fundamental valuations. The bears look at the price-to-sales ratio, which is astronomical at nearly 40 times, while the industry average is closer to 5 times. They look at the fact that the company is deeply unprofitable and burning cash, hence the dilutive $100 million raise. And they look at the short interest, which before today's short squeeze stood at a massive 29.22% of the float. Those short sellers are the ones feeling intense pain right now, as their thesis, awful financials, is being overrun by the market's enthusiasm for the AI story. This is a classic battleground stock, the kind that retail investors using the Robinhood app or SoFi Invest are drawn to because of the volatility and the binary outcome. It's the polar opposite of a stable online investment. This isn't something you put into Schwab Intelligent Portfolios. This is a speculative bet. The more conservative investors, perhaps those using Fidelity Wealth Management or a Fidelity brokerage account for their retirement, might look at this and prefer the safety of Fidelity mutual funds or Fidelity ETFs. But the institutional involvement is real. Filings show that major players like Fidelity and BlackRock are in fact significant holders. They aren't trading the daily wiggles. They are holding a position based on the long-term technological shift, likely managed through platforms like interactive brokers, which are built for handling such volatility. So what does Navitas actually do? The company is a pure play in next-generation power semiconductors. This means they design and sell chips based on gallium nitride and silicon carbide. For decades, the entire world has run on silicon-based chips, but silicon is hitting its physical limits for high-power applications. GaN and CIC are what's known as wide bandgap materials. In simple terms, they are far more efficient. They can handle higher voltages, switch faster, and run significantly cooler, all while being much smaller than their silicon counterparts. This is not just a small improvement, it's a foundational shift. For an EV, this means faster charging, longer range, and lighter onboard chargers. For a solar inverter, it means converting more of the sun's energy into usable electricity. And for an AI data center, the most power-hungry facilities on Earth, it means dramatically better energy efficiency, which translates directly into lower operating costs and a smaller thermal print. This is the technology reality that Navitas is selling. They are a fabless company, meaning they design the chips, where they have over 300 patents, and partner with foundries to manufacture them. The entire Navitas 2.0 pivot is about taking this core technology, which they proved in the mobile charger market, and aiming it squarely at these much larger, more profitable, high-power industries. The Nvidia deal is the first major validation of this strategy. But it's also a race. They are not alone. They compete with established giants like onsemi and Wolfspeed, as well as other players trying to get a piece of the GaN and CIC pie. This brings us back to today's explosive 15% move. The market is acting as if the $6.75 placement was the absolute bottom, a floor set in stone. Anyone who shorted the stock on Friday's news, expecting it to break $7 to the downside, is now trapped and being forced to cover at $9 and higher. This is a technical, momentum-driven event, but it's fueled by a fundamental narrative. The $100 million in cash is now seen as rocket fuel for the Navitas 2.0 plan, not an anchor of dilution. Here's the question I want you to think about, and I want to see your answers in the comments. Given this aggressive pivot, do you think Navitas's revenue will bottom in Q4 at $7 million? Or is this a sign of deeper, more painful problems as they try to enter these new markets? Let me know what you think. Looking forward, the expectation versus